Some other big changes to net operating losses. Previously, we were able to carry back a net operating loss for 2 years and carry it forward for up to 20 years. Now, they've closed that door to be able to carry that net operating loss backwards and then offset taxable income you might have had in the last 2 years, but are going to let you carry that forward forever now. So you'll be able to carry it forward as long as you need to be able to carry it forward until you're fully able to utilize that NOL. They've also put a cap on that, so now we can only use that NOL to offset up to 80% of your taxable income. In the past, we've been able to use an NOL to offset 100% of your taxable income. So some significant changes there in tax rates for corporations and the ability to use that net operating loss to offset your income. So those are the big changes for a taxable corporation. Laura, what about what I'm going to call our non-taxable corporations, our corporations that file a tax return but don't pay their own tax?
Those are called flow-through businesses. And your veterinarian practice might be set up as one. Chances are it very well could be. A flow-through business means that your business itself does not pay income taxes itself as an entity on the income, but rather the taxable income and some of those deductions flow from the business to the individual owners, typically through the Form K-1 that the business files, prepares, and gives to each of the individual owners. So this would mean if you're a flow-through business, you're either set up as a S corporation, perhaps a partnership. Your practice might be set up as an LLC. With an LLC, you could have one member, you could be a single member disregard entity, or with an LLC, again, you might have multiple owners as well. That is an option. Another pass-through example is a sole proprietorship. You may also own the building that you practice in. If this is the case, this is likely through a partnership if you own it with perhaps other veterinarians or partners or business people, or maybe it's set up as an LLC. Here again, the building entity itself does not pay income taxes on the profit, but it has a flow-through effect and is reported on your individual income tax return. Now, why is this all important? With the new tax laws, there is a new business deduction in town, and it's called the Qualified Business Income Deduction. The Qualified Business Income Deduction, you might hear it referred to also as QBI. That's our little acronym for it. This was probably the most talked about and pretty much the most complicated part of tax reform. Matt, you'd probably agree with that.
Absolutely.
It's a new deduction specifically for flow-through businesses, available starting in 2018, and this is one of those rules, like many of them, that is set to sunset in 2025. When the corporate tax rates were reduced, as Matt mentioned, from 35% to 21%, the people working on the laws didn't want small businesses to be at a disadvantage, so this new deduction helps equalize the playing field with the new corporate tax rates in effect. Today we're going to talk about the highlights of this new deduction, not get into too much of the nitty-gritty, as we would probably need a good 2, 3, 4 hours and probably a couple cocktails to get through that. So really, the qualified business income is a potential maximum 20% deduction that's available to flow-through businesses. So again, your S corporation, your partnership, your LLC, if you're a sole proprietor. And the deduction amounts to up to 20% of your qualified business income. Now, limitations will start to apply when taxable income exceeds a threshold amount, and then the deduction is limited to either 50% of the wages of your business or 25% of the wages plus 2.5% of your fixed asset base. Again, here's where it gets nitty-gritty, and we're going to take this back to a higher level conversation. Another key point of this that particularly affects everyone on this webinar is that this deduction phases out when income increases for service businesses. And service businesses are considered those who are practicing health, law, accounting, performing arts. I've got them all listed on the slide here, but we're going to zone in for a little bit on health. A veterinarian practice is considered a service business under this definition of a health business. So these rules apply to you. We as CPAs and an accounting firm are in the same boat, so we're all in good company here. Here's a chart that really summarizes a little bit about what this 20% deduction is about. As a vet practice, we're going to focus on the middle column here that talks about service businesses, since a veterinarian practice is a service business by definition of this rule and this law. So where might we see some of the different factors at play here with this new deduction? If your taxable income before this new qualified business income deduction is less than $315,000 if you're married filing jointly, or $157,500 as a single taxpayer, you qualify for the deduction, and then we'll go through the process of calculating what that deduction is. When we look at taxable income, that varies by individual and is determined on the individual level. So really it's a business type deduction, but it's the individual that determines whether or not they qualify for it and then claims it on their own personal income tax return. Now the rules are to change a little bit for when your taxable income increases from $315,000 to $415,000 for those of us that are married filing jointly returns. And here's that threshold point where the deduction starts to phase out for the income from service businesses. And then one thing that complicates the calculation is there are some limitations here based on the W-2 wages or your fixed asset base for this calculation. And then another key point here is that when your taxable income increases a little bit more and you're now over that $415,000 married filing joint amount, or $207,500 if you're a single taxpayer, there's no deduction for income from a service business such as your veterinarian practice. The limitations apply in full here, so essentially what happens is this deduction is not one that's available to you. Now, remember, this is a deduction that uses business information, but it's applied at an individual. So if you're in a multi-owner practice, chances are it's possible that some owners may be in a tax situation where they receive the qualified business income deduction. Some may be in that phase-out range, and some of you may have no deduction at all, because it all is based on, at this point, your personal income, which of course varies between each one of us because we all have unique situations. Another thing that's worth mentioning too is that the specifics of this calculation for qualified business income and the deduction vary between the different types of pass-through entity options that we have. For example, the calculation is different for an S-Corp versus for a sole proprietorship versus for a partnership. Plus, with the new reduced corporate income tax rates, really our key highlight here is that it's time to revisit the structure of your entity and consider, does it remain the right choice for you? This is something that you're going to want to consult with your CPA and your attorney on. It's really a business-by-business type conversation that you will want to sit down with your consultants on and determine whether or not it makes the most sense for your business from a financial and tax perspective. This new deduction certainly has the potential to save you some tax dollars. Purchasing equipment can also reduce your tax burden, and there were changes to those expensing rules as well. Matt, can you take us through those highlights?
You bet. Since you did the hard work of covering that 20% deduction, I'll do the easy stuff on depreciation. So we did have some changes to the bonus depreciation rules under the new Tax Act. It was 50% on new property, so we could write off immediately 50% of our cost basis in that new property under the bonus rules. And any new property now purchased after September 28th of 2017, we can take a full 100% deduction on that property. And it also doesn't have to be new property. This bonus deduction is now available on used property. So a huge benefit here for lots of practices. This applies to any property that's got a life of 20 years or less. So any exam tables, any cages, waiting room furniture, office equipment, all your other medical surgical equipment should fall into that category. And also land improvements, and then qualified improvement property, which is improvements on the inside of your building that don't really change the structure of your building, are also eligible for this bonus depreciation. The other big depreciation option we have is Section 179 expensing. So this is another way where we can write off the full cost of any new equipment or assets we're purchasing. It used to be we could only write off the first $500,000 of purchases. Now they've increased that limit to the first $1 million of purchases. So for most of the practices we work with, if you can write off the first $1 million of purchases you're making in a year, you're really getting a big benefit, and you're usually able to write off all the purchases you're making in that year. There's a phase-out in place, so if you're purchasing more than $2.5 million of new equipment, we might not be able to take that full $1 million deduction. And there's still a limit of $25,000 on each SUV, heavy, large truck you're purchasing for the year. Again, land improvements, qualified improvement property are included in here, and also some roofs, HVAC systems, fire protection, alarms, things like that we also get to include. So again, another powerful increase for most businesses. We've got not only the bonus depreciation changes, but this 179 expensing changes. And then the other big change relates to auto deductions within a business. Now, as we talk to a lot of our vet clients, a lot of the practices we work with, this is usually a big discussion about who really these auto rules apply to. In our minds, in talking to practices, large animal practices, we probably have a good application here. A mixed animal practice, we have a good application. Or if somebody's got a mobile clinic, there's probably a good application here. But really, it's got to be an automobile of some kind that's used in the business more than 50%. So more than 50% of the miles on that vehicle have to be business related, not personal related. And remember that that trip from home to the practice in the morning and from the practice back home at night aren't business miles, those are personal commuting miles. So unless you're a large animal practice, mixed animal practice, usually getting over that 50% usage test is really, really difficult. But if you can get over that limit, we've got some nice big increases in how much of the vehicle's cost we can depreciate right away in year 1, 2, and 3. You can see those limits are, for year 1, it's all the way up to $10,000 now. Last year it was at $3,160. So just a huge increase there. And then for the SUV heavy truck that weighs more than 6,000 pounds, we've got a nice deduction for 179 purposes of $25,000 a year, and the balance after that we can usually deduct 100% of that. So we're getting a great set of deductions there on the auto rules if we can prove that that auto is really legitimately used more than 50% in your practice. So with all those changes, one of the big questions and issues is going to become, when do we use 179 or when do we use bonus depreciation? A couple things to remember: that your Section 179 deduction is limited to your income in the practice. So we can only take enough 179 to get your taxable income down to 0. With the bonus depreciation, we might actually be able to create a loss in the practice. So we'd have some net operating loss potentially that we could carry over to next year, or if you're a flow-through business, a net operating loss that we could use to offset other income on your tax return. Wisconsin does follow the 179 rules, but does not follow the bonus depreciation rules. So depending on which one you select, you might have some differences between your federal return and your Wisconsin return. And then on the 179, we get to pick and choose asset by asset whether or not we want to use it. On the bonus depreciation, we have to select by asset class. So, for example, all of your medical equipment, we'd either take bonus or we wouldn't take bonus. All of your qualified improvement property, we could take the bonus or we could not take the bonus. But we can't get as granular and take asset by asset. So lots of big depreciation changes that are really going to have an impact this year. Any other minor changes, at least compared to those, Lori, that we need to be concerned about for this year?
Oh, for sure. I think the other hot topic we were hearing about when the rules originally came out on tax reform about almost a year ago, Matt, was really changes to the meals and entertainment deductions, particularly entertainment. As you know, beforehand under old tax rules, much of the entertainment of the entertainment dollars that a practice was spending or an individual was spending through their practice ended up being 50% deductible in some situations, and now those entertainment expenses are no longer deductible. So here we're talking about club dues, sporting events, plays, orchestra, etc. Not just that, but also like the premiums you might be paying to get access to seats or the cost of luxury boxes here too. So this change to meals and entertainment was one that definitely generated a lot of questions early on when it came out, and recently the IRS released some more guidance that we can rely on until the final rules are written regarding particularly what's changing for the meals part of the meals and entertainment deduction. So food and beverages are not considered entertainment, and those typically remain 50% deductible. So if you're having a business meeting over a meal where you're discussing business, that's still 50% deductible. If you have meals with your business associates where business is being discussed and you're doing it over food, again here this is still 50% deductible. And one thing that I think is still a great benefit is the IRS still allows us to deduct 100% of our holiday party and annual picnics, those things that we're trying to do with our employees and create a happy environment for them. Those are still 100% deductible as long as it's not extravagant and lavish. One thing I want to mention here too is sometimes there is food and beverage combined with entertainment, right? Maybe at a sporting event. You'll want to make sure that you're getting an itemized bill when there is a situation where you have food and beverage and entertainment that is showing you the portion that was food and beverage. If that's the case, if you have an itemized receipt like that, the IRS will allow you to deduct that portion of the food and beverage at 50%, but not deduct the entertainment. So just a little record-keeping comment on that. And really, those are the highlights in terms of what changed for businesses. Now we're going to transition a little bit into what individual tax changes might you see? As business owners, much of what happens at the business level also equates down to yourself. One of those things being business income. This next slide here is showing you the old tax rates on the left compared to the new tax rates starting in 2018 or this year on the right. So what we're seeing here is that both years have 7 tax brackets, but if you look a little further at how these brackets line up, the rates overall are lower. For example, the 10% rate, 15% rate, 25% rate that we're used to, those rates are now 10%, 12%, and 22%. If you look a little closer too, you'll notice that they widened the tax brackets. Take example on the far right where we're looking at the rates in effect for 2018. $157,000 of income fills up the 24% tax rate. If you look over on the left, last year that would have gotten you well into the 28% tax bracket here. The next slide shows these same tax rates and the different tax brackets for married filing joint last year on the left, this year going forward on the right. And as you can see here, similar things going on. Again, 7 tax brackets for both years, but overall lower rates and wider brackets. The other thing that tax reform did was it removed what we called or referred to as the marriage penalty. The tax brackets had been set up as such where the single tax brackets were wider than the married tax brackets. So essentially, there were some situations where 2 single people were paying less taxes individually as single people versus if they were to get married. And the tax reform has pretty much done away with that. If you were to put the single rates and the married rates side by side, you'd see that the married tax brackets are just about double what the single tax brackets are. So there's some people that are happy about that. Some things we did not see changes to are the preferred tax rates on qualified dividends and capital gains rates, nor did we see any changes to the net investment income tax rates. That 3.8% tax rate still remains for certain taxpayers. Another big change we're seeing on the individual taxation side is a change in standard deductions. The standard deduction for a married filing joint couple used to be $12,700. That has almost doubled to $24,000 for 2018. I've also got the standard deduction amounts listed up here for head of household filing status and single filing status. Ultimately, what we're going to see with the increase in the standard deduction is that more people will be taking this standard deduction and less people will be itemizing their deductions. Now, with these lower tax rates, wider brackets, increased standard deductions, you might be thinking, this is great, right, Matt? My tax bill is going to be so much less than it would have been last year. But some of these changes to the itemized deductions, as Matt is going to explain, they might mitigate some of those tax savings.
Yeah, Laura, you got to give out the good. Now I get to give out the bad and the ugly with all these changes. So I think the first significant bad change, if you will, is on the itemized deduction side. Starting now on your 2018 return, we're going to be able to deduct a maximum of $10,000 of real estate, property, sales, and income taxes. In the past, you could deduct all of your real estate taxes on your first and your second home, all of the property taxes you might have paid, depending on which state you were in, and all of your either sales or income taxes on your itemized deductions. Now we're limited to one $10,000 cap for all of those combined. So we're seeing a number of practice owners who are taking a significant decrease in their itemized deductions because of this change. You can still fully deduct your property taxes, real estate taxes, sales taxes, income taxes paid by your business on your business tax return, but on your individual return, we're getting a significant limitation there. Some other significant itemized deduction changes Almost all of your miscellaneous itemized deductions have been eliminated and they will no longer be deductible. So these were things like your unreimbursed employee expenses, your tax preparation fees, any investment fees you're paying, any casualty loss deductions you got, unless it's now in a presidential declared disaster area, those are no longer deductible. So a significant decrease in your itemized deductions there. We have some new limits on mortgage interest that we're able to deduct. In the past, we could deduct the mortgage interest on your first and second home up to $1 million of debt. That new threshold is now $750,000 of debt, so we can only deduct the interest on the first $750,000. And in the past, we could deduct the interest on your home equity line of credit, no matter what you use that debt to do. Now, we can only deduct that home equity credit if it's to build, improve, construct your house. So you can't use it to pay off credit card debt, to buy a new car, to put a kid through school. You can only use it on your home if you want to deduct that interest. And then last, some changes to charitable contributions. We got one good change in here. We can now deduct charitable contributions up to 60% of your adjusted gross income, but that was the only good change. On the downside, we can no longer deduct what you're paying for your right to purchase athletic tickets to your alma mater. So if you're paying any dollars to a foundation for the right to purchase those tickets, in the past you used to be able to deduct usually 80% of that as a charitable contribution. Now that's no longer deductible. If you're getting tickets in exchange for that quote-unquote charitable contribution, that's no longer deductible.
Ouch.
Yes, no fun. Some changes to medical expenses and healthcare provisions here. We can now your medical expenses only have to exceed 7.5% of your adjusted gross income for 2018 to get that itemized deduction. Starting next year, 2019 through 2025, that threshold jumps up to 10%, so increase coming next year. And then the Affordable Care Act mandate is effectively repealed as of January 1st of 19. So no more penalties for not having health insurance starting in 19. So all those changes on the itemized deduction side bring us to what is, I think, the most common question I'm getting from individuals. Am I going to be able to itemize deductions this year, or am I going to take the standard deduction? And as we look at this, and as I talk through this with clients, if I'm talking with somebody who's married filing a joint return, I think that the important things I think about are the standard deduction for that couple has jumped up to $24,000 for 2018. So if I want to itemize my deductions, they have to exceed $24,000 before I'm going to get any benefit to itemizing. I know that my maximum deduction for state and local income taxes and real estate taxes is capped at $10,000. So to get over that standard deduction, I've got to have mortgage interest and charitable contributions that exceed $14,000. If I don't have a mortgage, if I'm not doing $14,000 of charitable contributions, I'm not going to get over that limit for my itemized deductions, and I'm going to take the standard deduction. If I still have a big mortgage balance and I'm doing lots of charitable, I might easily get over that $14,000 threshold, so I'll take my itemized deductions instead of my standard deduction. It really depends on where you are with your mortgage on your house, if you own a house, and what your charitable intentions are. If you're not going to get over that threshold, one of the things we've talked to a lot of clients about is looking for a way to group your charitable contributions from multiple years into 1 year, and trying in that 1 year to get yourself up over that $14,000 threshold to get a tax benefit for those deductions. Lots of different ways to do that. One of the ways we're doing is through a donor-advised fund with a lot of clients. So that is an option and one way to leverage yourself into that better position. What other changes do we have to look forward to on the individual side, Laura?
Well, we've got a few listed here, but we're getting close to wrap-up point here. Have a couple minutes left, so I'll again encourage you, if you've got a question, quick jot it down in the chat box, and we'll be ready to address it as Matt and I are wrapping up here. But back to other changes, here's a little bit of a laundry list, if you will, of some other things that are new for 2018. First one being that personal exemption is repealed. This was a tax deduction of $4,050 per person and your dependents. So if you are married and have 2-3 children that you're claiming as dependents on your tax return, you'd have that roughly $4,000 times 5 people deducted on your tax return. That's gone away with these new rules. Moving expenses, there used to be a deduction for that. There is no longer a deduction for moving expenses, with the exception if they were incurred by a member of the armed forces, still deductible. So that change affects those of us looking for transitions. Another big change is alimony. Alimony for divorces happening January 1st, 2019 and beyond is no longer a deduction for those paying alimony. No longer is it taxable either for the person receiving that alimony. So this is kind of a game changer for those people going through changes in marital status and working through that new change in their life. The child tax credit, there's some changes made here in part to help make up for the loss of the personal exemptions that we talked about. The child tax credit used to be $1,000, now it is up to $2,000 for those people qualifying as a qualifying child. Basically, this means age 16 or younger, certain relationships are defined, and you must claim them as a dependent on your tax return. This was a deduction that also was commonly phased out for those in higher incomes. They did increase the phase-out ranges, too, so that those phase-outs for this credit doesn't start until $200,000 for those that are single or head of household filers, or $400,000 for those married filing jointly. So, Matt, I think we're going to see a lot more of our clients getting this child tax credit back this year.
Absolutely.
Also, there's a new dependent care credit. This is a $500 credit for dependents in your household that don't meet the definition of, I'm doing air quotes, qualifying child. Where we're going to mostly see this is for those children that have aged out of the child tax credit, so typically those kids that are no longer under the age, or age 16 or younger here. So you might get another $500 credit for those college kids that are still your dependents. The other change we saw that's going to benefit a lot of taxpayers, especially those in middle income ranges, is with AMT. The old rules used to be that once your income hit the mark of like about $250,000 through about $750,000, it was likely that you were paying this alternative minimum tax, and it added easily a couple $1,000s to your tax bill each year. So the changes that are in effect now are that the exemptions are increased, and the phase-out starting point for these exemptions was also substantially increased. So under these new rules, there's a lot of taxpayers that are not going to be falling in that AMT range anymore, which is a good thing. Helps offset some of those loss of itemized deductions, right, Matt?
Exactly.
And then estate and gift tax also saw some changes here, too. I'm going to particularly talk about the new estate tax exemptions. The basic exclusion for a single person used to be about half of what it is now. So that's increased from about $5.5 million to $11.2 million per person. So if you're a married couple, essentially it's double that, up to $22.4 million now. So here's something that we all want to plan for. None of us know when we're going to pass, but we probably have a pretty good idea if we're doing some financial planning on what our estate might be when we do pass. But this, again, is one of those exemptions that is set to sunset in 2025. So we have to look out for the next few years, but also what might change beyond that. And then last but not least, we've got a new fiscal cliff here. The timing for most of these new changes that we talked about today are that they're in effect from 2018 until 2025. And at some point nearing 2025, I'm sure the world will be abuzz again with what future changes we might see to tax law once those sunset. So that wraps up the slides and the information that we wanted to go through today. Do we have any questions that we can address?
Great. Again, I just wanted to mention that there is a chat feature. If it is not up on your screen, just hover over the bottom of the PowerPoint and you'll see some faded buttons, and then you just click on the chat box button and it can pop up. So type your questions in there. We do have one, Matt.
Yeah, so we got a great question here. I talked a little bit about donor-advised funds and how people are using that to change their charitable strategies here. But somebody asked, in addition to that, are there any other strategies people are using related to charitable contributions now? And I think one of the things we're seeing, and this isn't really a new idea because of this tax reform bill, but we are seeing lots of people giving away appreciated stock to the charities they like and want to support. And the benefit here is that if you're giving away the appreciated security, you get the charitable contribution at the high level, that fair market value at the time you're giving away the stock or the mutual fund. But you don't have to recognize any of the capital gain that might be built in on that stock. So you avoid paying the 20% capital gains tax on the appreciation on the stock, but you still get the benefit of that appreciation for the charitable contribution. So that's a great benefit for people to consider. The other thing I think that we're going to see a lot more of is for people who are age 70 and a half and are of the age where they have to take required minimum distributions from their IRAs. I think we're going to see a lot more people decide to do their charitable giving from their IRA and do a qualified charitable distribution out of their IRA. And the benefit here is that that qualified charitable distribution meets your RMD requirement for the year, so you satisfy the IRS's demand that you take money out of your IRA every year. But instead of trying to take a charitable contribution on Schedule A for it, we get to exclude it from income on your return. So if your charitable contributions aren't enough to get you over that $24,000 standard deduction limit, what we can do is instead of trying to take it as an itemized deduction, if you do the qualified charitable distribution, we get to reduce the taxable amount of your RMD by that amount. So I think we're going to see lots more people looking at that as a strategy going forward.
So one of the benefits of aging we have to look forward to.
That's right.
You can't do it until age 70 and a half.
Exactly.
Great. Well, we are over our time. Thank you, Matt. Thank you, Laura. And thank you, everybody, for joining us today. If you do come up with questions after we log off of this webinar, Matt and Laura's contact information is up on the screen. Feel free to jot it down and either call or email them with any questions you have in the future. Also, I wanted to mention that our upcoming webinars in our veterinary practice webinar series are coming up in January. So for those who are either going to buy or sell a practice, whether it is in the very near future or even 10 years down the road, you should start thinking and planning about it now. So on January 22nd, we will talk about veterinary practice transitions from the buyer's perspective, and then on January 24th, we will talk about it from the seller's perspective. If you're interested for more information and even to register, you can go to svaaccountants.com/events and then scroll through the events and select the one that you're interested in. Again, thank you so much for joining us today, and I hope everyone has a wonderful day. Thank you very much.